Closer look at the markets as we head toward the opening bell. Joining us now, Jason Hunter, head of global fixed income and U.S. equity technical strategist at J.P. Morgan, and CNBC senior markets commentator Mike Santoli, who, wow, you just look really healthy and well rested. And
you think so?
Well, what time was?
I mean, I got up at the same time. There was just no demand for me until now.
Oh, I'm sorry.
You did not.
Wow, he's fishing.
You're
always, you're always.
No, just,
you just look really well.
Yeah.
Okay. So what do we have? We had how many days in a row? We have 8. Where do we go on the Dow?
Yeah, I think the Dow squeezed out 8. Well, we were down on Friday.
Friday, so that would have been. Yeah. I think 8 by Thursday.
I think the significant thing is up 6%. In 3 weeks from the low in mid-August, 6 or 7%, and it brought you to within a whisper of the all-time high. And what I really was focused on is all these things that got to extremes in August and have partially reversed, right? Yields got very low, equity valuations relative to bonds got very low, investor sentiment got very low, and I think U.S. economic expectations got very depressed as well. They've all partially reversed from extremes, but not yet gotten to the point where they're kind of too high where you'd worry about them overshooting. So that's where we were going into the weekend, and I think that today's market response to what happened over the weekend into the oil price spike is pretty mild, and you kind of could have had a pullback of 1/3 of 1% this morning for almost no reason, let alone a big one like we got.
So, Jason, since you've covered our technicals in equities, just comment on where you think we are in terms of support, resistance, and momentum for equities, and then we can talk about on the global fixed income side. It's weird the way things start moving in one direction, then you get this event over the weekend, and it just seems to. It's almost the market obviously didn't know what Iran or whomever. I don't want to say Iran, but it didn't know that the Saudi oil fields were going to be attacked. But good reason for rates to head higher.
Yeah, well, I mean, to what's already been said, a large part of the rotation since mid-August has been into value anyway. Energy being the second biggest component of the S&P 500 value sector. This just gives it a bit of a further tailwind in terms of the rotation. That said, our view all along, all summer, we suggested getting, somewhat a bit more defensively and cash heavy in May as the headlines turned. And our view has been if we're going to get this late cycle rally extension, it's going to come because there's a better, move to a better space with trade that's going to allow cyclicals, things that are correlated to global PMI to move up. That's largely the value basket cyclicals that have underperformed for the period that we've been in the trade war.
Did you say get more into cash in May, and have you told people to put it back to work yet?
Yeah, so that's right. So in August, we published a note, basically looking for the silver linings in the sky filled with storm clouds. And we said, basically, watch these individual indices as they start to break out of their August bases. You simply just stop yourselves into risk, into long exposure. That's the area where you want to be invested if we're going to get a late cycle push. Those are the areas that are going to outperform in that type of a rally. And as long as they're working, as long as the aggregate market participant is pricing in the increased odds that we're going to see something along the lines of a deal or at least a truce, we're happy to stay in that risk and look for the late cycle extension here.
In yields, you think the lows are in?
So if that story plays out, yes, that's the case. We've seen some of the most overbought conditions in history, particularly at the long end of the curve. If you're looking at something like the weekly RSI on the 30-year, the market's now turning from that. So to the same token, we're looking at risk markets for validation that yields will continue to go higher into next year. And as long as we see those positive signals, we'll see stair-step pattern in yields higher at the intermediate sector. But we'd like to stay on the bearish side, provided the risk markets are giving the right signals.
So we aren't going negative?
Not right now, it seems lately. But that could change quickly with a headline. We've seen that before twice this year, actually.
Even the global yields have risen a little, right? We're at 15 trillion in negative sovereign now instead of 17. It's something.
It's something. I think that the time to start worrying about it is when not everybody knows the exact gross amount of debt that's negative yielding. Because I think that storyline got so heavily played. And to your point about August, we all got fixated on this idea that somehow we're extrapolating down to zero. We still had a long way to zero in our own yield. So I think that's kind of where we are. I mean, the one thing I would point out is with the Fed this week, even, again, without the weekend's events, in May and in July, market kind of pushed to a new record high. The Fed more or less did what was expected, and that was like an excuse for a pullback. And, not saying it's going to happen. In fact, if anything, people are talking about it a lot, so maybe it won't happen this time.
All right, Jason. So overall, give me a support level and a resistance level because you're a technician, for the S&P.
So the S&P 2940, as long as you're above that, we maintain a high conviction view that we're going higher. Next resistance, the couple of trend lines that held the rally so far this year, right around 30.40 to 30.60. But if value continues to go, we think the market will push through those trend lines and extend.